Celebrity investors get a lot of love and hate at the same time. Some people adore them and follow every piece of advice they give. Others hate and bet against them with everything they've got. Take Cathie Wood, CEO and CIO of ARK Invest. To some, she is the messiah of investing in the future, and to others, she's a reckless investor who plays with other people's money. Since this is happening in the stock market, you can practically love her by investing in ARK ETF or hate her by investing in SARK, an ETF that bets against ARK's flagship ETF and was one of the top performing ETFs in 2022. The same investment opportunity is now available for Jim Cramer's fans and haters. A few weeks ago, the SJIM ETF was launched, which allows investors to bet against the host of CNBC's Mad Money show. Would betting against a celebrity like Jim Cramer pay off, or is it a waste of your money? Let's find out. I'm Hoda, founder and CEO of StockCard, and on this channel, I share detailed fundamental analysis and interesting investment stories. Today, I'm curious whether betting against celebrity investors can do you any good. Betting against Cathie Wood's flagship ARK ETF would have made you good money at the end of 2022, but you would have lost money if you invested in it in 2023. Does the same strategy apply to betting against Cramer? Today, I dig into SJIM ETF, also known as Inverse Jim Cramer ETF, launched by Total Capital Management. It takes the opposite position of every advice Jim Cramer gives his audience on TV and Twitter. The ETF is launched by the same investment company that launched SARK ETF and hasn't yet made much return since its launch on March 1st, 2023. That may not be enough time to judge an ETF's performance. So we need to dig into how the short ETF works and fundamentally discuss whether it's a waste of our money to invest in it or not. Before we start, I know you know that I strongly believe every investor should do their own research or ask a professional advisor if they need advice. My videos are here to educate and entertain you only. To help you, I actually built an awesome research platform so everyone can do their own research. If you're not a user yet, go to stockcard.io, create a free account, and start doing your own research. Later in the video, I'll show you some previews of the tool and how to use it too. SJIM ETF holds 59 equities and has managed to attract $6.5 million in asset under management. It is called SJIM, as in short Jim Cramer. However, it doesn't always hold a short position. Jim Cramer doesn't always pick his stocks. In many cases, he argues against the company. So the SJIM ETF is a mix of long and short bets on the opposite side of Jim's position out of a target list of 20 to 50 securities. The Prospectus document explains that the fund manager has a list of holdings in the fund, and if Cramer recommends one of those holdings, then the fund sells it. And if his advice is to sell something, the fund will invest in it. For example, Jim Cramer warned investors against Bitcoin in January 2023, which means the ETF is now taking a long position in Bitcoin. Here lies the first red alert. This ETF comes with lots of subjective decisions by the fund manager. How does he pick the first 20 to 50 holdings? How fast does the fund react to a buy or sell tweet? What is a clear and definitive buy or sell decision by Cramer? How much the fund allocates to each security? When an existing holding becomes a sell position, does the fund sell all or part of the existing holding? And so on. In other words, this isn't a pure short Jim Cramer fund that automatically reacts to Cramer's decisions. It leaves much to the fund manager's discretion. Naturally, if decisions are left to the discretion and the judgment of the fund manager, the next best question is, who is this fund manager and what has he achieved as an investor in his career? The fund manager of SJIM ETF is Matthew Tuttle. He is a financial celebrity himself, regularly appearing on CNBC and Fox Business. It looks like he's interested in assets with extreme emotions surrounding them. He created the famous SARK ETF that shorted ARK Invest ETF when people started hating on ARK Invest as the growth stocks rallies reversed in 2021. Back in 2020, when the special purpose acquisition companies were all the hype, Matthew also created the SPAC and new issue ETF, ticker SPCX, to invest in SPACs to benefit from the interest in the special purpose acquisition companies. Interestingly, he sold SARK short ARK ETF to ASX Capital Management, a company he had joined once they acquired the SARK ETF. After a few months, he decided to launch more ETFs such as SJIM ETF on his own and parted ways with ASX. We have to give him credit for his courage and boldness. And although we don't know how much he made on the sale of his SARK ETF, he must be in a good position to fund the launch of several ETFs on his own from the proceeds. Running an ETF costs you at least $200,000 per year, and until the money invested in the ETF grows into $20 to $30 million, so the management fee pays for the operating capital, he needs to fund such expenses out of his pocket. If nothing else, that means that he has courage and he also knows how to capitalize on market hype. However, there's no evidence of his investment skills and whether he's a good investor. And that's a red flag if you can't trust the investment acumen of the fund manager you're betting on. Talking about the cost of running an ETF, the fund's management fee is one of the highest I've seen ever. In its prospectus document, the fund manager explains it plans to charge 1.2% fees from its investor. Compare that to Cathie Wood's ARKK's 0.75% fee, and you'll see how much more expensive SJIM is. The fund is planning to waive 0.25% of its fees until June 2024, bringing the effective fund expense ratio to 0.95, but even that is one of the highest expense fees I've noticed in the recent years. The next risk is something interesting that most people have likely not heard of or paid attention to. If your strategy is shorting someone else's ideas, you are 100% dependent on someone else to make decisions. For example, when Jim Cramer goes on vacation, there's nothing to do for SJIM ETF. In running a fund, you want to reduce your risks as much as possible, and being dependent on someone else's decisions is a big risk for you. Now, talking about Jim Cramer, is he a good investor? If he is a good investor, we shouldn't bet against him. His Mad Money TV show draws nearly 400,000 viewers, and he has 2 million followers on Twitter. Why do so many people follow him? There's no official record of Cramer's investment returns over his entire career as a hedge fund and a TV personality, but research by a pair of a teaching assistant and a student from the Wharton School of Pennsylvania showed that his investment decisions through the Mad Money charitable trust portfolio underperformed the S&P 500 by 3% over a 17-year period between 2001 and 2017. By the way, the charitable trust portfolio is a stock picking club. You can pay $400 per year to join. Well, the fact that his investment decisions underperform the market, however, doesn't necessarily mean betting the opposite of his decisions would have overperformed the market. If he tells us not to invest in NVIDIA, as an example, and NVIDIA goes up by 5% after his recommendation, you and I could have gained 5% by taking the opposite position of Cramer. However, it is very likely that AMD has gained more than 5% in the same time period. In that scenario, even though betting against Cramer gave us a better return than listening to his advice, the decision may not have been the best choice. Blindly shorting someone else's decisions without proper due diligence, even if that person has proved to be not a good investor, doesn't guarantee the best results. And since we talked about AMD and NVIDIA, I recently published a video to compare Intel with its competitors such as NVIDIA and AMD. I'll leave a link to that video in case you'd like to watch it after this video. While reading its prospectus, I realized this is not a single ETF. It comes with opposite sibling ETF LJIM, a fund managed by Total Capital and Matthew that mirrors Cramer's decision. This fund has 46 holdings and 240K in asset under management so far. This sibling of the SJIM ETF does exactly what Cramer does. In a way, Total Capital Management is very smart. It is mitigating its strategy risk by creating a pair of ETF that go opposites of each other. That's smart and makes sense, but only if the funds manage to attract the same assets under management amount and can neutralize each other's risk. At this point, however, more than 6 million is poured into SJIM and less than $500,000 is invested in the long ETF. So here's what we've learned about SJIM ETF. The ETF relies on several unclear and subjective decision-making by the fund manager. Although its fund manager seems to be a business-savvy ETF creator, we don't know much about his investment skills or track record. It is an extremely expensive ETF with about 1% expense ratio. The ETF comes with its inherent risk that it is reliant on someone else's decision, and if Jim goes on vacation, the ETF is on hold. Shorting Cramer's decision without proper due diligence on the opposite position isn't guaranteed the overall best return, and the SJIM ETF is matched with LJIM ETF to neutralize risk for the fund manager, but due to very small amount of assets under management, it is too early to gauge its success. So in a way, SJIM is a fun concept, and it highlights the fact that many celebrity and TV personalities are no better at investing than the rest of us. But it comes with inherent risks around its strategy that is hard to mitigate. I'd say there are better investments than betting against a person and are even more fun and intellectually stimulating to do the research and figuring them out. Now it's your turn to pull up SJIM and LJIM ETF cards on our website and do your own research. Share your perspective in the comments so we can all learn from each other. I'll leave a link to their ETF cards in the show notes, and I'll see you next time.